You know this, stocks hitting more all-time highs again today. But there's something big that's happening in the bond world. That's a total 180 from what happened just a short time ago. So let us fire up the old fast money time machine for a trip back all the way to late summer when this was playing out on our air.
A brutal day on Wall Street, stocks plunging as the yield curve inverted for the first time since 2007. The selling widespread, the Dow dropping more than 800 points.
Yeah, remember that late summer panic of the yield curve inversion, imminent recession, imminent doom, stocks going to zero? Well, today, the spread between the 2- and 10-year treasuries hit the highest level of the year. So, Dan, Nathan, is the bond market sending an all clear for the stock market?
Of course not. I mean, think about it. When was the last time we had a yield curve inversion? It was like 2006, and the stock market didn't top out for another 12 to 18 months, which is what everybody was saying last summer anyway. They're like, chill out. The market's not going to crash here, but we have a year to 18 months. That's the average. So to me, I don't find that particularly useful one way or another. I don't think anybody was saying on August 6, 2019, the market's crashing right here because the 210 spread just inverted or something like that.
But so I don't know.
It actually did sound like Melissa said exactly that. We were down 800 points.
That did sound like that.
Am I the only one that heard that?
I think the commentary afterwards, though, showed that you do have this yield curve gets a lot steeper right before a recession. And what's interesting, if you watch that yield curve along with jobless claims start to tick up, yield curve starts to get steeper, and then you have the recession. But that's 12 months from now. So we're looking, Q4 of 2020 at the earliest.
Well, the question is the yield curve steepening from the short end or the long end, and what do you want to see? And I would make an argument that the Fed cutting rates and sending that vibe out there, you basically saw a bull steepening, which was coming in from the short end. The most important thing I think that happened today is that the Riksbank in Sweden decided to say no mas to negative interest rates. And what we're seeing across Europe, we've heard this with the BOJ. We kind of are waiting for the Fed. The irony, of course, is the Fed that really started all of this globally. Zero interest rates are not working. And we're hearing central banks start to make this plea that they're going to try something new. And ultimately, that will inevitably push yields higher. That's very important.
But I want to make one point. Your point is that when the Fed cut interest rates on July 31st, 25 basis points for the first time in 10 years, they fixed the inverted yield curve, and they did it 2 more times. Right. And who the heck knows what was going to happen from there on out. The market was getting killed that day because Trump introduced those new tariffs. That combination was a weird sort of situation. So the point was 12 to 18 months, that's when you get the recession on average in the post-World War, blah, 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 whatever. And who knows what the market does in between the inversion and the recession.
And we'll wrap it up there and bring in Tommy, but I think there's 2 things here. Number one, it's a good lesson to our viewers and listeners that just one indicator doth not a market make. And I got to correct something that Tim said, because the Swedish Riksbank did not say no mas, they said inte mer, which means no more in Swedish. All right, let's now bring in Tom Lee. He is co-founder and head of research at Fundstrat Global Advisors. You just released your 2020 outlook this morning. Bullish, Tom?
Yeah, I think 2020 is going to be a continuation of the kind of market we saw this year. But it's a lot more about the fact that earnings could beat significantly on the upside. We've got a PMI recovery, an inventory build, easing financial conditions, plus potential for fiscal stimulus. All this means earnings could grow more than 10%.
The majority of our guests that we've had on with their outlooks and their predictions are optimistic, but not wildly so. 7, 8, 9% gains, high single digits for the S&P 500. Where exactly do you stand?
So I think the minimum's plus 10.
Minimum?
Yeah, and that's just an earnings with flat PE. I think PE could expand, so I think total return next year will be better than 10%. So it'll look like 2010.
Tom, what part of the subsectors do you think you get the most earnings inflection here, whether it's, again, recovery from trade? Where do you think you're getting most of that?
Yeah, so 45% of the earnings growth should come from tech, industrials, energy, and basic materials. And a lot of them are value sectors, which do well when PMIs recover. So I think if you want to be cyclical, overweight those, and it's a lot like 2016, 2017.
So, Tom, I'm curious. We talked a little bit about the bond market, right? And we know that the Federal Reserve has now said they're going to tolerate some more inflation. When does that start to erode the earnings that you're talking about? And do we have to worry about that in the first half of 2020?
Yeah, inflation's a wild card because a little bit probably is embraced by markets because, as you guys are saying, negative rates aren't perceived as healthy. But a hot inflation read would probably scare people because of what central banks have to do. So it's uncertain. But I don't think expectations are high, and I think we won't see anything for at least the first half.
Hey, Tom, we talk about this. We were just talking about the yield curve and everything else, right? So what about financials? Where do you stand right for next year, for 2020? How is that going to be a great area to be? You mentioned tech, you mentioned energy, you mentioned a lot of things. I don't know if I heard you say financials.
Oh, yeah. I should have mentioned financials because it's 21% of the Russell 1000 Value Index. Financials have really been good earnings producers in a tough environment. And as the curve steepens, they can make more money. They're under-owned. So, yeah. Maybe it's consensus, but I think they're going to do great next year.
Yeah, I want to make one point. All summer I heard you as lead up to the inverted yield curve. You were like, don't panic. And I give you guys a lot of credit, and I read your stuff, and you guys have been dead on that. But the point about the stock market next year, and you're saying multiple expansion, didn't we see a lot of that, Tom, this year? Year over year, if you think about where S&P earnings estimates were at the start of 2019
Apple, Microsoft.
and where they're going to be right now, we're down like 12 points from and the S&P is up 27%, and it's trading at 19 times. Isn't that how we just got this expansion? Isn't that anticipating what you say is probably a base case scenario for next year in earnings?
Yeah, so 2019 was all PE.
Yeah.
You started off at 12 times. We're going to exit at 18, so it's been E's collapsed and PE has gone up. But, when you start to do forward estimates, I think earnings estimates are going to go up for 2020 and 2021. So I think the multiple might actually contract, but consensus is going to bring numbers up. So I think that's why you can still get 10%, but you could lose a point or two on PE.
Making a lot of people happy with that prediction if it comes true, Tom.